Hello and welcome. Thank you for joining us. Before we begin, some brief housekeeping and a message from our compliance team. Firstly, please be aware that this session will be recorded. Secondly, this webinar is for educational purposes and of a general nature only. It does not constitute personal advice. It must not be acted on or relied on. The presentation is not an offer, recommendation or solicitation. Today, we will be hearing a short presentation from Andrew Torrington, Managing Director and CIO of Woodbridge Capital. Woodbridge is an Australian and New Zealand investment manager specialising in finance across commercial real estate, build-to-rent and agriculture assets. After Andrew's presentation, I'll be asking a few questions and provide the opportunity for the audience to do the same. Before we get into the presentation, Andrew will tell us a little bit more about Woodbridge Capital and the private credit landscape in Australia.
We're a non-bank lender, so non-bank lending is a space we play in. It's referred to as private credit as well, but basically non-bank lending came out of the GFC when the banking regulators tightened the prudential limits of banks. They stopped their, they slowed down their lending practices, they changed their leverage on their balance sheet. So all of a sudden the banks couldn't lend what they used to lend. Banks have traditionally done 99% of lending in Australia and New Zealand, so all of a sudden this dislocation came about, so that the banks couldn't lend to what they'd normally lend to. We're in a falling interest rate environment, so you've got the banks tightening, you've got investors coming to the market with a lot more cash, falling interest rates, so they both sort of came together with the investors wanting to put their money somewhere to get earned, and the non-bank market coming to fill the void with banks. So that's how non-bank was created, private credit. They call it both the same just to confuse people, but non-bank private credit is the same thing. So it's relatively new in Australia, non-banks, but it's not relatively new in US, Europe. So US, Europe has about 40-50% saturation of non-banks. So in the US, for example, it's about sort of 60% non-bank, 40% bank. UK, very similar, 40-50% non-bank. So those markets are very well entrenched and used to non-bank lenders. It's just a new product to Australia where non-bank lenders came up. So we're playing on this dislocation with non-bank where we look at the forward of Australia and we think that US, Europe is a good guide to what non-bank will get to in the future. And we think that currently we're about 85%, 90% banking, so 10-15% non-banking. So we think the runway for that market is very, very strong.
Yep.
So that's how non-bank sort of came about. Non-bank is a bank. So you go to a bank, you traditionally would have gone to a bank for a housing loan, for an office loan, for a loan for your hotel, or you would have gone for an agriculture loan. So the bank offered multi-product. Non-bank is a bit more specific, so you don't go to many non-banks and get multi-products across it. Typically, most non-bank lenders, private credit lenders, are lending to specific asset classes. So the market has slowly getting used to that as private credit emerges, but it's still lending practices, lending disciplines, and lending into the commercial market. So we talk about the dislocation. It's dislocation / lack of competition. It's the fact that there's greater demand for private credit than there is supply from the banks. So what we're doing as investment managers is taking advantage of the dislocation.
Yep.
And super earning for investors, filling the void that the banks can't currently do. So a question we get asked a lot is, what exactly is private credit? So as I said, it really just refers to non-bank lending. It's the same logic as what a bank would do in terms of doing loans to borrowers. Private credit is a mix of asset-backed lending and corporate lending. And I think it's important for investors to understand the fact that having an asset-backed loan is very different to having a balance sheet-backed loan, and it comes with different risk profiles and different returns as well.
Yeah, but we'll investigate a little bit further on that.
Yeah, yep. So private credit is sort of split between asset-backed and balance sheet-backed, and then you start splitting between the security of your loan. First mortgage being the most secure type of loan that you've pretty much got full control of the asset, and then you talk about second mortgage loans that you sit behind the first.
Yep.
Mezzanine finance, and then you go to preference equity. So you've got multiple types of security pool in the assets as well.
Yep.
So for investors, it's sort of understanding, whether you're asset backed, whether you're balance sheet backed, whether your first mortgage, second mortgage,
Yeah.
and then exactly then what kind of assets you're actually investing in. Is it, typically we cut between commercial real estate, CRE, infrastructure, and agriculture.
Yes.
So you've sort of got that little waterfall of, what's your security, what type of assets are you lending in, and then what specifically type of assets are you in. So, so that's the sort of way we cut through private credit. And our borrowers are normal average borrowers.
Yep.
They're developers, they're asset owners. These aren't borrowers that the banks wouldn't do by any means. So we're not doing lending to poorly vetted borrowers. We're just doing lending to borrowers that can't get bank loans because the bankers have tightened.
Yep.
I think there's sometimes a bit of a myth that this is bad credit. These parties aren't worth lending to. They're perfectly normal, normal borrowers. Just they can't get bank debt.
Yeah.
So, and like any borrower, there's some borrowers you never go near because they make no sense. But that's part of your vetting process. So people say, why do they come to non-bank? Well, they come to non-bank because they can't get a bank loan, and they come to non-bank because non-bank private credit is much faster. Typically, we are writing loans in doing DD in 4 to 6 weeks. If you went to a mainstream bank at the moment, you're probably talking 12 to 18 weeks if you get credit approval to do a loan. So for asset owners buying assets or developers developing projects, that uncertainty is not commercial in the market. So they're paying private credit for the privilege of certainty and speed, and probably the asset class specialist, having people actually understand the asset.
Sure.
So that's why we can get above returns on private credit versus what a bank is typically lending at. So that's sort of how we came about. Next slide. So these are the typical types of loans that we're lending into. So commercial real estate is a pretty broad term, but typically it includes offices, hotels, apartments to sell.
Yep.
So build to rent and build to sell is probably a terminology that people are slowly getting used to in Australia. So build to sell apartments are the typical apartments that are being built by developers, and people are buying them off the plan or buying them at completion. And the build to rent market has emerged in certainly Australia the last couple of years, but well entrenched in Europe and US again, where people are renting apartments rather than buying.
Yep.
That's come out of high asset prices, rental returns, all the rest of it. So that's certainly becoming mainstream in Australia. And I think with inflation, increasing build prices, the cost of developing these apartments, that the apartment price coming up, build to rent as an asset class will certainly come to the fore.
Yep.
And then a bit of agriculture. So we typically we're doing 80-85% commercial real estate.
Yep.
That includes build to rent.
Yep.
As an asset class, and then we do a bit of land-backed agriculture.
Yeah.
So we don't do commodity-backed agriculture.
Okay.
We do land-only, say, particular.
Yeah. Is there a reason for that?
Just backing loans by commodities have fluctuating prices. So land as an asset class sure can fluctuate, but if your loan's supported by the crop or a cow or whatever, then clearly those prices fluctuate.
Yeah.
Commodities fluctuating daily, so you might think you're in an LVR of 60%, but tomorrow you could
move pretty quickly.
Yeah, it could be at 70%,
Yeah.
it could be 50%. So we're a bit more conservative. We think that tying ourselves to a valued asset that's not fluctuating is better credit. So in terms of how the investment works, like a bank takes money from its deposit holders, private credit takes money from its investors. So basically, private credit funds are taking investment from investors. The fund then is investing that money as a lender into the underlying loans. So very similar to a bank, you've got a lender with normal loan documentation that fully secures the asset, lending money to the borrower for a purpose. So that purpose could be buying an asset, developing an asset, getting a permanent on an asset, whatever it is. And then you've got repayment terms on that loan, and then the loan's repaid, and then the capital's recycled.
Yeah.
So for private credit funds, it's become fairly mainstream now. The structures are pretty simple.
Yeah.
Is that the underlying fund has security over the asset, so the fund always ultimately owns the asset if something went wrong. And that's pretty much the structure of most private credit funds now. The income of the fund is the interest that you're earning from your loans.
Yeah.
So basically, all your income's coming out of the loan interest. And for borrowers, they can be paying interest along the way, they can be capitalising interest, or a mix of both. So it just depends on the loan, depends on the loan to value ratio going into the loan. So we sort of do a bit of blended mix, but typically in our fund, we're talking about 80-85% commercial real estate loans that are generating income along the way. And that we're repaid within 18-month average term.
And just a note on this fund, that interest that will be distributed monthly to investors.
Yep. So monthly distributions along the way with an annual top up.
Yep.
Okay. So I think certainly as private credit's emerged over the last few years, I think the important question for investors now is in this asset class is what's the difference between first and second mortgage and blended funds. So probably not specifically first and second mortgage, but what we're seeing in the market now is a mix of blended portfolio of private credit portfolios coming in. So investors are coming into these portfolios with a mix of first mortgage fully secured, second mortgage unsecured, mezzanine unsecured, corporate loans. So I think there's a risk that some investors think they're going into first mortgage funds or more secure funds when they're actually going into more blended funds. So something that we're picking up on is we just think first mortgage only credit is the best risk rate or returns in this market. We think because it's so secured, if there's a risk of asset price fluctuations, first mortgage is always protected the most. So we're trying to be very transparent with investors. First mortgage only fund. We don't invest in second mortgage. We won't dress up a first mortgage as a second mortgage loan. We won't surprisingly put in a corporate loan. We're just doing good old boring first mortgage, nice and secure, well protected on asset class. And the typical, first mortgage, it's capital preservation. That's what the first mortgage fund's about. It's capital preservation with income.
I think we've picked up on this point in speaking to investors in the last few weeks. Is this point about transparency. As this asset class has got through to sophisticated investors and wealth managers, they want that transparency. They get worried and cynical when they see a corporate loan pop into the portfolio, or there's a lot of mezz or second. They just want to know what's under the hood. It's their job to manage the asset class and the debt class that they want to go into. So just having the transparency is important. We're always going to stick to first mortgage.
100%. And you're right. Transparency, I think, is important as private credit matures as well, because I think investors have the right to understand what loans are in their portfolios. And they have the right to be able to see when the security is changing, because the returns on a first mortgage loan should be very different to a second mortgage loan, or a corporate loan. There's nothing wrong with lending in corporate loans, but I think investors need to understand that blended portfolios carry different risks and rewards for the first mortgage.
And our clients aren't managing just to a return profile; they're managing to a risk return profile, and that's important. They're sophisticated; they want to know what's in there, and they can manage the risk.
So typical characteristics, first mortgage funds, they're focused on capital preservation. So that's the main characteristic of a first mortgage. It's got stable income. They're well protected against asset falls. So if there are underlying pressures on asset prices, and certainly inflation will, and rising interest rates, could see asset prices under pressure. First mortgage funds are the most protected form of debt in that, because we're coming in at loan to values of 60-65%. We're talking about underlying asset prices falling by 35-40% before our asset is impaired, or the principal is not protected, if you like. So never say never, but that's a fairly large fall in an asset price to be hit. And the risk rate and return on first mortgage is pretty attractive when you're looking at earning cash plus 6 to 8 on that type of debt when you've got capital preservation and you can churn off income. I think is at the moment this market. And probably two other things with first mortgage, it's the loan control of first mortgage fund is a lot easier. So for investors, so as an investment manager, us controlling the first mortgage loan, we pretty much have full control over the borrower. If we ever need to step in the asset, we can. Second mortgage doesn't enjoy that at all. You're reliant on what the first mortgage does. So if we ever have any risk of impairment of an asset, this first mortgage, we can always just step in and sell a loan. So for investors, it's a bit of diversification too. He's talking about capital preservation, running yield type private credit versus more blended private credit. So that's sort of why we're picking on first mortgage. So what that means for investors, yeah, it's pretty much that, as I said, these are capital preservation type funds that obviously there's risk with any investment, but your risk is mitigated to some point when your loan to values, sub 60, 65%. Is that within commercial real estate, for example, you're talking about hotels and shopping centres and residential apartments. So any one of those asset classes could fall at different rates. And certainly, in the last few years, we've seen shopping centres come off in terms of asset prices, and office buildings at the moment are enjoying cap rates in the threes, which is sort of, I would say, are getting a bit stressed.
Yep.
So each asset is different, but certainly the nature of first mortgages, you've got a blended portfolio through it. So I think the other points on the slide is just, first mortgage, private credit uses the same terms as three ways, which is joyful for, I'm sure, you in terms of distributing product. But, senior secured first mortgage is the same. It just means that we're the senior part of the capital stack, that we rank first. Mezzanine and second mortgage are the same. It just means they rank behind us as first mortgage. And that, if there's any risk the borrower can't pay the loan, first mortgage can step in.
Yep.
And in the past, I've certainly done that before, where I think there's a risk of asset impairment, is that, we would exercise our right to step in and sell the asset and make sure that the capital is always preserved. So a little bit about our process, our wagon wheel. So this is the way that we cut investments, basically. So there's a bit of special sauce for investment managers like us in this, but basically, the first little green box is how we source our deals. So sourcing deals, just in good deals, is obviously important. It's how you start. So we see a lot of deal flow. We're seeing 400 or 500 deals a year.
Yep.
We might be doing 1 in 10, 1 in 8 deals a year. We're picking the best risk-adjusted loans in that, and some of those clearly aren't for us, some for other funds. That's fine.
Yep.
Our fund is picking a specific type of loan. So we pick the loans, we go through and vet them. We research and sort of filter each loan we get. So that's important in terms of research of the asset class.
Yep.
If you're lending into office at the moment, there's a bit of concern in the market. There's office dead. We're saying, well, we think office is actually okay. But, so you're researching the asset, then you're starting DD on your loan.
Yep.
So DD typically runs 4 to 6 weeks. We've got a 110-point check system that goes right through the asset. It's not just box ticking, it's fronting the borrower, it's face-to-face communication, it's understanding the asset, what are the risks, if it's apartments, how close is it to a railway station, what's the suburb price doing, what's the square metre rates doing. So you're very much sort of cutting through it. Then we get a valuation on the asset. So we get independent valuations on all of our loans, which is an important distinction again in private credit, is that we only use tier 1 valuers. We get a loan that's 90 days current, so we don't use old valuations.
Yep.
So it just means when we get a value, we're taking a very conservative approach.
Is that unusual?
It's not as common as it probably should be, I guess, in private credit.
Right.
It's just our conservative nature, and if you've ever got a house valued, you know that when a valuer values your house, they're probably already valuing it 10-15% less than what it's worth anyway. So when we go in a loan with a 60% valuation on an external valuation, we're probably going in at 50, 55 really.
Yeah.
But it just builds up that conservative nature of the fund, that we're always getting an independent view of the asset value. And sure, values can be wrong, but they're very conservative by their nature. It's a well-regulated industry, so we rely on that value, and then we stress test it, and then we say, okay, if we're lending into an apartment building, what happens if that asset value fell by 30%? Could it happen? And so we stress test our assets to 10, 15, 30% falls in asset prices with capital preservation in mind.
Yep.
So, and then once we've stress tested them, because certain asset classes could fall, and subdivision is probably the asset class at the moment in outer suburbs of Sydney, Melbourne, that are becoming probably highly speculative. They're paying a lot for the land. So those asset classes, you might go into low LVRs because we're more concerned about those asset values falling versus a CBD office building that 30% fall in the asset price might be unusual. So we stress test the asset. We go through to our loan documentation. We use external lawyers for that. Tier 1 lawyers, again, full control over the borrower, full step-in rights, full reporting rights. We have a credit committee, so the credit committee approves the loan, goes through and asks all the questions about process controls, ESG, all that stuff has gone through in detail. We financially close the loan, which means we fund it.
Yep.
So that's when the fund puts its money into the loan.
Yep.
So, and some loans are drawn down up front, some loans might be drawn down over a 6-month period. And then we click into asset management reporting. And there's a bit more special sauce in running a loan book, and that's, I think, what we saw in COVID was a lot of investment managers dialing in to loan management, not fronting borrowers face to face, not doing physical asset inspections. I mean, just the way I've been brought up in property, I think it's crazy. You've got to be front to front with borrowers. It's communication. It's just inspecting the asset. No surprises. Yeah, just, I think, so I'm a big believer in that sort of communication. And then we monitor it. So monthly reports. We're all over the borrowers. They've got to produce reports to us. We then produce a monthly loan report for investors. And you talked about transparency before. I think that's a differentiation of the market, is that investors can get looked through to loans. We're not just giving a portfolio and saying it's a blend. If you actually care and you're interested, you can actually see the line.
Okay, so that's an important point.
So, and then we click into loan repayment. So for us, 18 months average loan. If a loan is, the capital preservation again kicks in. So if a loan is 1 or 2 months late getting paid, nice to get an investor. Sure. We'll probably put the borrower in default. We're probably earning plus 5% on the loan. No risk of capital preservation. We're just super earning as investors. So, yes, that's the sort of our overlay. And I think for us, as a firm too, ESG is part of us. Is that we're big on real ESG. We're doing negative screens on our investments. We're capturing ESG information through the process as well. So I think the interesting thing for private credit at the moment is we've got inflation. So private credit has actually had inflation in Australia and NZ. So I think for investors, we're quite lucky at the moment that we can take this benefit. So what happens, and it depends on the private credit fund, but for our fund, we're talking about generally our loans are linked to BBSW floating rates plus. So the benefit, of course, to investors is that as interest rates come up, as they did last week, is that that's a straight pass through to investors. So having an inflation hedge as a product is quite unusual, and it's certainly not typical of fixed income type products. And that's the benefit of private credit.
We might want to talk about that a little bit more. I noticed some of the questions coming through. Clearly, there's concern out there in the investor community that there's these interest rates going up, inflation, etc. What does it mean? So you're saying that generally they're floating rate loans and they'll be passed straight through?
100% back to investors.
Not like a bank.
No, and I think that's what people have got. If investors have already got private credit, I think that's the next question you got to ask: is when interest rates come up, am I as an investor getting a straight pass through? I think that'll be the next trick. But for us, 100% pass to investors. So that's the beauty of private credit in inflation. You've got interest rates coming up, and your returns are coming up with it. So and when obviously pre-inflation, pre-interest rates coming up, we were doing more fixed rate loans. Because the returns were coming down for investors, so we could protect the floor. Now we're doing floating rates where we protect the floor, but the ceiling is unlimited. So
And I think just going back, there was another question came through that we should answer. What does ESG stand for?
Environmental social governance. So it's the way that we look at investments in terms of making sure it's responsible investing, that we're not investing in assets that aren't responsible lending practices, be it military, be it be it environmental. Just good governance assets that are well protected for investors. You'll hear a lot more about ESG in the coming.
Fairly new to this space.
So yes, that's inflation is a pretty unique opportunity for investors at the moment, and it's it's a strange thing to say out loud that we're happy with interest rates going up. And it feels a bit strange that probably investors to think that's a good thing, and certainly for us, it's good diversification for investors. Risk in investing, of course, there's always risk with lending. Once again, if you cut back to the types of loans you're doing, I think, the first mortgage funds is the capital preservation funds are probably less risky in the struct, but of course there's all the normal risks associated with loans.
Sure. And we should talk a little bit about the product. It's obviously, as everybody on this podcast would know, it's a wholesale product. Can you give us some of the key features of the product itself?
So we're talking about first mortgage loans, average loan term of 18 months. LVRs, average 60-65% type loans. The fund itself is kicking off cash plus 6 to 8% in terms of targeted returns, and obviously cash rate will affect with that 7 to 9, 8 to 10 type delivery to investors.
We'd expect a sort of running yield to be distributed monthly.
Yep. Yeah, so we're talking about monthly yield, payable sort of circa 4% along the way. So if investors want cash coming from those products, they can get it, or they can reinvest, obviously, and then an annual top up to the fund. Minimum $25,000 investments, so fairly accessible for investors. I think that's the way private credit is going. I think in the past we would have set higher limits to private credit investors, but I think it's a very investable product now for SMFs, non-bank investors, wholesale investors, obviously, but coming in. So pretty vanilla type fund, low fee structure, environment, and pretty structured.
Yeah. Now, I've heard on different podcasts where you described with deep domain knowledge. Can you give us a little bit of your background and why perhaps that's really important in the current environment?
I think most people would know invest in something you understand. Yeah, so I'm certainly a big believer. If you don't understand what you're investing in, even personally, then don't invest in it. And I think in commercial real estate, that's even more important. So yeah, I'm a crusty old real estate guy. I've been in property for a long time. I've played the developer. I've been the subcontractor. I've been a builder, and I've been a lender, obviously. And I'd certainly say lending is probably the easiest of those. It's quite topical at the moment with being a builder, but I guess I and the team have got the benefit of understanding an asset class very well. It makes it easy for us to invest in it because we understand it.
Yeah.
When we look at an asset, we take the right lens on it. I'm not coming from, I guess, a banking view. I'm just trying to tick 100 boxes and say, does it fit?
Yep.
And ultimately, I won't lend in stuff I don't understand. So
yeah, you were saying that your pipeline of opportunities is quite large. You see, hundreds of loans per year. How many loans would you typically actually write after looking at them?
So typically do about 1 in 8, 1 in 10, Andrew. So,
Yep. So discern.
Yep. And then that starts DD.
Yeah.
So, and some loans pull out of DD sometimes. Some loans go through due diligence and they don't stack up. The valuation comes in not as we expect, or the borrower AML KYC might not be clean, or just there's a risk that the asset value is not right, and we would wholesale bail out. So, and that's your property really mindset. Yeah, just we're looking at the asset with our experience, saying yes, we believe it.
Thank you, Andrew. And to everyone out there, thank you for joining us today. That's all we have time for. We encourage everyone to visit our website at woodbridgeprivatecredit.com or call the team to find out more about the fund. See you next time.